Hi, welcome back. You're watching MF Corner, and with us now we have Hemant Rustagi, CEO of Wiseinvest. Hemant, thanks very much for joining in. So today we want to talk about saving and investing and what is the difference, because often, we hear people using these terms interchangeably. So can you set the record straight?
Well, Sumera, I agree with you. I think there are most investors who believe that saving and investing is the same thing. Then, of course, there are investors who believe that investing is all about putting money in your bank account and that's enough. While I would say broadly, the objective of saving and investment is to secure your financial future by following a disciplined approach. There are a number of reasons why investing is completely different from saving. Of course, one has to save first to be able to invest, but it's investing that helps you retain the value of your money over a longer period of time. So let's understand what the basic difference between these two. When we talk about saving, it's actually putting money in a bank account. So obviously the returns are low, but the liquidity is very high. The approach to saving has changed over a period of time. Earlier, I think saving used to be a leftover from income after expenditure. But having realized that this is not the approach which allows investors to save regularly and save a particular amount every month, the approach changed to saving first and then spending. I think over a period of time, we have seen the approach to saving has changed. But the job is basically, when we talk about saving, it's just to keep some money aside out of your income. When we talk about investing, investing is basically when you buy assets like equity, debt, real estate, or commodities, with the expectation that they will earn healthy return for you over a period of time. So investing is broadly, I would say, a long-term process. It requires you to do certain things. It requires you to decide your asset allocation, choose the option that can give you the best from that asset allocation, and understand the risks which are basically attendant to investing in these market-linked products. So investing requires you to have knowledge. Investing requires you to understand risk. So you can see that saving is what you keep aside out of your income, and investing is when you put your money to work. And that is what, like I mentioned earlier, allows you to kind of retain a value of your money over a longer period.
Absolutely. And, it was said that wealth is not earned, it is saved. Now, I guess we need to just alter it and say what is invested. But Hemant, even for low-risk investors, is there any merit in just saving, right? Or one should, even low-risk investors should try to strive this balance between saving and investing?
I think this is a very important question. I think many investors struggle to find answers for this, especially when we talk about investors who have a low risk appetite. Look, I think we need to understand there are two risks that we have to kind of face when we invest our money as an investor. The one is risk to capital, the other one is risk of inflation. Unfortunately, most investors in our country focus on risk to capital. But that's exactly the reason why many people still think that saving is equivalent to investing. In reality, when you invest for the long term, let's say when you're talking about building a corpus for your retirement planning or your children's education, you're investing for 10, 15, 20 years. Even if you build a portfolio of equity, 100% equity, the chances of losing money are not there if you're a disciplined investor, unless you are a totally irrational investor and you're making changes haphazardly in the portfolio. So the fact is that even if you're a low-risk investor, you need to realize that you need to, like I said earlier, the investing is staying ahead of inflation over a longer period. It's very, very important for every investor to understand. Unfortunately, there are strategies, there are products, especially we talk about investing in mutual funds, that whatever it may be your risk profile, whatever may be your time horizon, there are products for you. There are hybrid funds, there are debt funds, there are debt-oriented hybrid funds, there are equity-oriented hybrid funds, there are dynamically managed asset allocation funds. So irrespective of the fact that you may have a low risk profile, you can still actually build a portfolio, and that's where your focus should be. So it doesn't matter whether you're a low risk or a high risk investor. I think every investor has to understand the difference between investing and saving and make sure that in the long run, their money grows not only in terms of number, but in terms of value.
Okay. Hemant, for both saving and investing, there are certain products or options that people would choose, right? The very obvious ones. What are the tax implications?
Well, look, I mean, when we talk about saving, generally, like I said, saving is like putting money in a bank. And now, what happens many a time, because the returns are so low, investors, focus more on the quantum of tax that they pay, and they feel that I'm paying very low tax. But the reality is that you're paying, in terms of a percentage, very high tax, because whatever interest you get from the bank account or a bank deposit gets added to your income. And if you're an investor paying tax at the rate of 20% or 30%, your tax outgo is very high. When we talk about investing, I think it's very, very important to follow a tax-aware investment strategy, and that's the benefit of investing in market-linked product. If you're investing in equity or equity-oriented funds, if you redeem your units after 1 year, you pay tax only at the flat rate of 10%. So clearly, investors in the high tax bracket benefit in two ways. One, obviously, the tax outgo is much lower, and second is every investor who invests in these funds over a period of time actually give themselves a chance to get higher return. Similarly, when you invest in the debt fund, mutual funds, compared to a bank account, if you keep your money for 3 years or more, it becomes a long-term capital gain. You get indexation benefit, and you pay tax at the rate of 20% after that. Let's understand by a simple example. Even if your return is 7% and the inflation is 6%, you're paying 20% on 1%, which is 0.2. So your post-tax return is 6.8, which will be much higher than what you get from bank account. So I think it's very important as an investor to follow a tax-aware investment strategy, because that can make a significant difference to what you get to keep at the end of your investment time horizon.
Okay, and just finally, Hemant, is there any rule of thumb about how much money goes into savings and how much should go into investing? What would you recommend?
Well, again, Sumana, I think very important aspect, even though there is a thumb rule of 50, 30, 20, which says that 50% should be for expenses, 30% for want, and 20% for saving. But at the end of the day, it's a thumb rule. I strongly believe that the problem with following the thumb rule blindly is that they do not take into account your personal situation. Whereas as an investor, you need to really focus on that. While it's absolutely important to have these three compartments, but how much will go into that will depend on your own situation. That's where I think the goal-based investment process, which has become very popular over the last few years, I think works out well. So what happens is you define your goal, short-term, medium-term, long-term. You set a target, you have a time horizon, you work out based on an assumed rate of return, how much money you need to invest. Now, these goals will also involve creating an emergency fund, which is what you do through saving. Then there could be objectives like buying a car or going for a family vacation. The fear that most investors have is that if I plan too much about future, I will have to compromise on the present. That also does not have to be done. So here, when you follow a goal-based investment process, you know exactly how much you need to invest. So you go work backwards, do budgeting, save first, and then invest. So I think it's important to follow a goal-based investment process. This kind of thumb rule can be just an indicator, but don't follow it blindly.
All right, Hemant, thanks very much for joining in and for explaining this concept to us. With that, we're going to wind up on MF Corner for now, but do remember to keep sending us all your queries. For now, stay tuned. The team of Closing Bell joins you next.